Lesson 1 to 3 Introduction to SPACs. Understand the concept and structure of SPACs. Special Purpose Acquisition Companies, SPACs, are a type of investment vehicle that have gained significant popularity in recent years. They are also known as blank check companies or shell companies. SPACs are created with the sole purpose of raising capital through an initial public offering, IPO, and then using that capital to acquire an existing operating company. Here's a breakdown of the concept and structure of SPACs. Creation. A SPAC is formed by a group of sponsors, typically experienced investors, executives, or financial institutions. They establish the SPAC as a publicly traded company by filing a registration statement with the relevant regulatory authorities, such as the U.S. Securities and Exchange Commission, SEC. IPO and funding. After the registration statement is approved, the SPAC conducts an IPO to raise capital from investors. The SPAC issues units consisting of shares and warrants, with each unit typically priced at $10. The funds raised from the IPO are placed in an interest-bearing trust account until a suitable acquisition target is found. Blind pool. At the time of the IPO, the SPAC does not have any specific acquisition targets identified. Investors contribute their funds to the SPAC without knowing the specific company or assets that will be acquired. This structure is often referred to as a blind pool. 2-year timeframe. SPACs have a limited timeframe, usually 2 years, to identify and complete an acquisition. If they fail to find a target within the specified timeframe, the SPAC is dissolved, and the funds held in the trust account are returned to the investors. Acquisition. Once a suitable target is identified, the SPAC's management negotiates and executes a merger or acquisition agreement with the target company. This process often involves obtaining additional financing to support the acquisition, which can come from the SPAC sponsors or through private investments known as PIPE, private investment in public equity, transactions. Shareholder approval. The acquisition or merger agreement requires approval from the SPAC's shareholders. Typically, a majority of shareholders must vote in favor of the transaction for it to proceed. The SPAC process. After the acquisition is completed, the SPAC and the target company combine, and the target company becomes publicly traded through the SPAC's existing stock listing. This process is commonly referred to as the de-SPAC process. Post-acquisition. Following the de-SPAC process, the shareholders of the target company own a majority stake in the combined entity, while the SPAC's original shareholders typically retain a minority stake. The management team of the target company usually remains in place and continues to operate the business. It's worth noting that SPACs have garnered attention due to their potential for rapid growth and their ability to provide retail investors access to investments traditionally reserved for institutional investors. However, they also carry risks, including the uncertainty of identifying suitable acquisition targets and the possibility of investors losing their invested capital if the SPAC fails to complete an acquisition within the specified timeframe. SPACs differ from traditional IPOs, initial public offerings, in several key ways. Here are some of the main differences. Purpose. The primary purpose of a traditional IPO is for an operating company to raise capital and become publicly traded. In contrast, a SPAC is specifically created as an investment vehicle to raise capital with the intent of acquiring an existing operating company. Timing. In a traditional IPO, the operating company goes through the process of preparing for the offering, including financial disclosures, regulatory approvals, and marketing, before going public. In contrast, a SPAC goes public first through its own IPO, and the target company is identified and merged with the SPAC at a later stage. Investment risk. In a traditional IPO, investors typically have knowledge about the company they are investing in. They can analyze the company's financials, business model, and prospects before deciding to invest. In a SPAC, investors contribute their funds up front without knowing the specific company or assets the SPAC will acquire. This introduces an element of risk and uncertainty as investors rely on the SPAC sponsors or management team to make a successful acquisition. Regulatory requirements. Both traditional IPOs and SPAC IPOs involve regulatory oversight, but the requirements may differ. Traditional IPOs are subject to the regulatory framework specific to the jurisdiction where they are listed, such as the Securities Act of 1933 in the United States. SPACs also need to comply with these regulations, but they often have additional requirements related to the acquisition process and the subsequent de-SPAC process. Proceeds utilization. In a traditional IPO, the capital raised by the operating company is used to fund its operations, growth initiatives, repaid debt, or other predetermined purposes. In a SPAC, the funds raised in the IPO are held in a trust account until a suitable acquisition target is identified. This provides flexibility for the SPAC to utilize the funds for a future acquisition process. A traditional IPO results in the operating company becoming publicly traded, while a SPAC's IPO only establishes the SPAC itself as a publicly traded entity. The SPAC then seeks a suitable acquisition target and undergoes a merger or acquisition process to combine with the target company, allowing the target company to become publicly traded through the SPAC's existing listing. Investor participation. Traditional IPOs have historically been dominated by institutional investors and underwriters, with limited access for retail investors. SPACs, on the other hand, have been popular among retail investors as they provide an opportunity to invest in potentially high-growth companies early on. Typically at a fixed price per unit, it's important to note that while there are differences between SPACs and traditional IPOs, there are also similarities and overlaps in terms of regulatory compliance, investor protection measures, and market dynamics. It's crucial for investors to carefully evaluate the specific characteristics and risks associated with both investment options before making any investment decisions. The popularity and growth of SPACs in recent years can be attributed to several factors. Accessibility. SPACs have provided retail investors with greater access to investment opportunities that were traditionally reserved for institutional investors. The structure of SPACs allows individual investors to participate in early-stage investments and potentially benefit from the growth of private companies. Speed and efficiency. Compared to traditional IPOs, SPACs offer a potentially faster route to becoming a publicly traded company. By merging with an already public SPAC, target companies can bypass the lengthy and complex process of preparing for a traditional IPO, including extensive financial disclosures and regulatory requirements. Flexibility. SPACs provide flexibility in terms of funding and valuation. The capital raised in a SPAC IPO is held in a trust account until an acquisition target is identified. This allows the SPAC to negotiate and structure a merger or acquisition that suits the needs of the target company, including securing additional financing through private investments, PIPE transactions, alongside the merger. Attractive deal structure. SPACs offer potential benefits for both the target company and the SPAC sponsors. For the target company, merging with a SPAC provides access to public markets and capital without going through the traditional IPO process. For SPAC sponsors, they can earn significant financial rewards if the SPAC successfully identifies and merges with a high-performing target company. Market conditions and investor demand. Favorable market conditions, such as low interest rates and abundant liquidity, have contributed to the growth of SPACs. Additionally, investors have shown a strong appetite for investments in innovative sectors like technology, electric vehicles, biotech, and clean energy. SPACs have been particularly active in these sectors, attracting attention and capital from investors seeking exposure to potentially high-growth companies, celebrity endorsements and high-profile mergers. The involvement of well-known individuals, such as athletes, entertainers, and business leaders, as sponsors or advisors to SPACs has generated significant media attention and investor interest. High-profile mergers between SPACs and prominent companies have further fueled the popularity of SPACs, creating a sense of excitement and potential upside for investors. It's important to note that while SPACs have experienced rapid growth and popularity, they also carry certain risks and uncertainties. Investors should exercise due diligence, carefully evaluate the track record and expertise of the SPAC sponsors and management team, and consider the specific investment risks associated with each SPAC before making any investment decisions. Lesson 2. SPAC Formation and Initial Public Offering, IPO. Study the process of forming a SPAC and taking it public through an IPO. The process of forming a SPAC, Special Purpose Acquisition Company, and taking it public through an IPO involves several key steps. Here's an overview of the process. Formation and sponsorship. A group of sponsors, typically experienced investors, executives, or financial institutions, come together to form a SPAC. They establish the SPAC as a shell company with the primary purpose of raising capital for future acquisitions. The sponsors provide the initial capital to cover the expenses of forming the SPAC, such as legal and administrative costs, business plan and structure, the sponsors develop a business plan that outlines the investment strategy and criteria for potential acquisitions. They determine the target industries, geographic focus, size of companies, and other specific parameters. The sponsors also establish the governance structure of the SPAC, including the board of directors and executive team, regulatory compliance. The SPAC sponsors engage legal counsel and other advisors to ensure compliance with the applicable regulatory requirements. This includes filing a registration statement with the relevant regulatory authorities, such as the U.S. Securities and Exchange Commission, SEC, in the United States. The registration statement provides detailed information about the SPAC structure, sponsors, business plan, and terms of the IPO, initial public offering, IPO. Once the regulatory filing is approved, the SPAC proceeds with the IPO. In the IPO process, the SPAC offers units consisting of shares and warrants to the public. The units are typically priced at a fixed price per unit, often at $10. The IPO is underwritten by investment banks or financial institutions that help market the offering to potential investors. Capitalization and trust account. The funds raised from the IPO are held in a trust account until a suitable acquisition target is identified. The trust account is established to protect investors' capital and is typically invested in low-risk, interest-bearing securities such as U.S. Treasury bills or money market funds. Public listing. Following the IPO, the SPAC's units are listed and begin trading on a stock exchange or over-the-counter market. The shares and warrants may trade separately or together as units, depending on the structure of the SPAC, target identification and negotiation. With the IPO proceeds in the trust account, the SPAC's management team begins the process of identifying and evaluating potential acquisition targets. They review business opportunities, conduct due diligence, and negotiate with target companies to find a suitable merger or acquisition candidate. Shareholder approval. If the SPAC management identifies a target company, they negotiate and execute a definitive merger or acquisition agreement. The agreement is subject to the approval of the SPAC's shareholders. Typically, a majority of shareholders must vote in favor of the transaction for it to proceed. The SPAC process. Upon receiving shareholder approval, the SPAC and the target company merge or acquire each other. This process, known as the de-SPAC process, results in the target company becoming publicly traded through the SPAC's existing stock listing. The shareholders of the target company typically become majority owners of the combined entity. Post-acquisition. After the de-SPAC process, the combined entity operates as a publicly traded company, and the SPAC sponsors or management team may continue to be involved in the management and operations of the company. The company's performance and growth potential are evaluated by investors based on its financial results, business strategy, and market conditions. It's important to note that the specific details and requirements of forming a SPAC and conducting an IPO may vary depending on the jurisdiction and regulatory environment. Engaging experienced legal and financial advisors is crucial to navigating the process effectively and complying with the applicable regulations. Examine the role of sponsors, underwriters, and investors in the SPAC IPO. In a SPAC IPO, initial public offering, various participants play important roles, including sponsors, underwriters, and investors. Here's an overview of their respective roles. Sponsors. The sponsors are the key individuals or entities that initiate and establish the SPAC. They are responsible for forming the SPAC, providing the initial capital, and overseeing its operations. Sponsors typically have extensive experience in finance, investing, or a specific industry. They play a crucial role in identifying potential acquisition targets, negotiating deals, and driving the overall strategy of the SPAC. Sponsors often commit a significant amount of their own capital to align their interests with those of the investors. Underwriters. Underwriters are investment banks or financial institutions that assist the SPAC in conducting the IPO. They help structure the offering, provide advice on pricing and market conditions, and act as intermediaries between the SPAC and potential investors. Underwriters help market the SPAC's IPO to institutional and retail investors, aiming to generate demand and ensure the successful completion of the offering. They also handle the regulatory compliance aspects of the IPO, including filing the necessary documents with regulatory authorities. Investors. Investors are individuals or institutions that participate in the SPAC's IPO by purchasing units or securities offered by the SPAC. Investors can include institutional investors such as mutual funds, hedge funds, and private equity firms, as well as individual retail investors. They provide the capital that the SPAC raises through the IPO, which is held in a trust account until a suitable acquisition target is identified. Investors participate with the expectation of potential returns if the SPAC successfully merges with a target company and generates value. Investors in a SPAC IPO typically have different types of securities to choose from. Units. Units are the most common offering in a SPAC IPO. Each unit typically consists of one share of common stock and a fraction of a warrant, which entitles the holder to purchase additional shares at a predetermined price in the future. Units are usually priced at a fixed amount, often at $10 per unit. Common stock. Common stock represents ownership in the SPAC. After the IPO, the common stock begins trading separately from the warrants. Investors who purchase common stock have voting rights in the SPAC and are entitled to any dividends or distributions declared by the company. Warrants. Warrants are financial instruments that give the holder the right to purchase additional shares of common stock at a predetermined price, usually higher than the IPO price, within a specified period. Warrants can offer potential upside to investors if the SPAC stock price appreciates. It's important for investors to carefully evaluate the terms, risks, and potential rewards associated with investing in a SPAC IPO. Conducting due diligence on the sponsors, understanding the investment strategy and target sectors, and assessing the overall market conditions are crucial steps for making informed investment decisions. Analyze the regulatory requirements and compliance involved in launching a SPAC. Launching a SPAC, Special Purpose Acquisition Company, involves complying with various regulatory requirements to ensure transparency, investor protection, and adherence to securities laws. While the specific requirements may vary by jurisdiction, here are some key regulatory aspects and compliance considerations associated with launching a SPAC. Formation and registration. The process of forming a SPAC typically involves registering the company with the appropriate regulatory authorities in the jurisdiction where it will be incorporated. In the United States, for example, this involves filing a registration statement with the U.S. Securities and Exchange Commission, SEC, under the Securities Act of 1933. The registration statement provides detailed information about the SPAC, its structure, sponsors, business plan, and terms of the IPO. Disclosure requirements. SPACs are subject to rigorous disclosure requirements to provide investors with the necessary information to make informed investment decisions. The registration statement and subsequent periodic reports filed with regulatory authorities must disclose the SPAC's financial statements, business operations, investment strategy, and potential risks associated with the investment. Additionally, any material changes, developments, or events that may impact the SPAC's prospects must be disclosed promptly. Investor protection measures. Regulatory frameworks aim to protect investors in SPACs by ensuring transparency and fair treatment. Regulations may require SPACs to establish safeguards, such as holding the IPO proceeds in a trust account until a suitable acquisition target is identified. These funds are often invested in low-risk, interest-bearing securities to preserve capital. The terms and conditions of the trust account, including withdrawal rights and interest accrual, are subject to regulatory guidelines, merger and acquisition approval. Once a suitable acquisition target is identified, SPACs must comply with regulatory requirements related to shareholder approval of the merger or acquisition. The SPAC typically holds a shareholder meeting where a majority of shareholders must vote in favor of the transaction. The approval process ensures that investors have an opportunity to evaluate and vote on the proposed transaction. Corporate governance. SPACs are subject to corporate governance rules and regulations, which typically involve establishing a board of directors with a sufficient number of independent directors. Independent directors play a crucial role in ensuring fairness and objectivity in the decision-making process. SPACs are also required to establish committees, such as audit and compensation committees, to oversee specific aspects of the SPAC's operations. Post-merger compliance. Following the completion of a merger or acquisition, the resulting publicly traded company is subject to ongoing regulatory compliance and reporting requirements. This includes filing periodic reports, such as annual reports, Form 10-K, quarterly reports, Form 10-Q, and current reports, Form 8-K, with the regulatory authorities. The reporting obligations aim to provide transparency and keep investors informed about the company's financial performance, operations, and material events. It's important to note that the regulatory requirements and compliance obligations for SPACs can be complex and may vary across jurisdictions. Engaging experienced legal counsel and other advisors is essential to navigate the regulatory landscape effectively and ensure adherence to all applicable laws and regulations. Lesson 3: SPAC Lifecycle and Trust Account. Explore the timeline and stages of a SPAC's lifecycle, including the IPO, the search for a target company, and the merger/acquisition process. The lifecycle of a SPAC, special purpose acquisition company, typically consists of several stages, including the IPO, the search for a target company, and the merger/acquisition process. Here's a timeline that outlines the key stages. SPAC formation. The sponsors come together to form the SPAC as a shell company. They establish the company, determine the investment strategy, and provide the initial capital to cover the expenses of forming the SPAC. Initial public offering, IPO. The SPAC conducts an IPO to raise capital from investors. In the IPO process, the SPAC offers units consisting of shares and warrants to the public. The funds raised from the IPO are placed in a trust account until a suitable acquisition target is identified. Trading and waiting period. After the IPO, the SPAC's units begin trading on a stock exchange or over-the-counter market. The SPAC typically has a specified timeframe, often around 2 years, to identify and complete an acquisition. During this waiting period, the SPAC's management team searches for a suitable target company to merge with or acquire. Target identification and negotiation. The SPAC's management team conducts a search for potential target companies that fit within the SPAC's investment criteria. They evaluate various opportunities, conduct due diligence, and engage in negotiations with the target companies. The goal is to identify a suitable merger or acquisition candidate that aligns with the SPAC's investment strategy. Merger/acquisition agreement. Once a suitable target company is identified, the SPAC's management team negotiates and executes a definitive merger or acquisition agreement. This agreement outlines the terms and conditions of the transaction, including the exchange ratio, valuation, and any additional financing required to support the acquisition. Shareholder approval. The merger or acquisition agreement requires approval from the SPAC's shareholders. Typically, a majority of shareholders must vote in favor of the transaction for it to proceed. The SPAC will hold a shareholder meeting to obtain the necessary approval. De-SPAC process. Upon receiving shareholder approval, the SPAC and the target company proceed with the de-SPAC process, where the two entities combine. This process involves various legal, financial, and regulatory steps to complete the merger or acquisition. The target company becomes publicly traded through the SPAC's existing stock listing. Post-merger operation. Following the de-SPAC process, the combined entity operates as a publicly traded company. The management team of the target company typically remains in place and continues to run the business. The performance of the combined entity is evaluated by investors based on its financial results, business strategy, and market conditions. It's important to note that the timeline and specific stages may vary for each SPAC, depending on factors such as the specific terms outlined in the IPO prospectus, the search duration for a target, and the complexities of the merger or acquisition process. Additionally, regulatory compliance and shareholder approval are crucial steps throughout the SPAC's lifecycle. Understand the purpose and mechanics of the SPAC's trust account. The trust account is an essential component of a SPAC, special purpose acquisition company, and serves a specific purpose within the SPAC's mechanics. Here's an overview of the purpose and mechanics of the SPAC's trust account. Purpose of the trust account. The primary purpose of the trust account is to protect the capital raised from investors in the SPAC's initial public offering, IPO, until a suitable acquisition target is identified. The trust account is designed to provide transparency, accountability, and investor protection. Mechanics of the trust account. Capital placement. When investors participate in a SPAC's IPO, the funds they contribute are placed in the trust account. The capital typically includes the proceeds from the sale of the SPAC's units, which consist of shares and warrants. Restricted access. The funds held in the trust account are segregated from the SPAC's operational funds and are subject to strict restrictions. The SPAC's management cannot access or utilize these funds for any purpose other than specific authorized uses outlined in the SPAC's governing documents. interest-bearing securities. The funds in the trust account are usually invested in low-risk, interest-bearing securities such as U.S. Treasury bills or money market funds. These investments aim to preserve capital and generate interest income while the SPAC searches for a suitable acquisition target. Safekeeping and oversight. The trust account is typically held by a qualified trustee or custodian, such as a bank or financial institution. The trustee is responsible for safekeeping the funds and ensuring compliance with the SPAC's governing documents and regulatory requirements. Use for acquisitions. Once a suitable acquisition target is identified and approved by the SPAC's shareholders, the funds held in the trust account are released to facilitate the completion of the merger or acquisition. These funds, along with potential additional financing through private investments, PIPE transactions, are used to fund the transaction and provide capital to support the target company's growth. Return to investors. If the SPAC fails to complete an acquisition within a specified timeframe, typically around 2 years, the funds held in the trust account are returned to the investors. This provides a level of protection for investors in case the SPAC is unable to identify a suitable target or secure shareholder approval for a transaction. The trust account mechanism aims to safeguard investor funds and ensure that the capital raised in the IPO is utilized for its intended purpose of acquiring a target company. It provides transparency and a measure of protection for investors, as they can be confident that their funds are segregated and cannot be used for purposes other than those outlined in the SPAC's governing documents. Evaluate the significance of the trust account in protecting investor funds. The trust account plays a significant role in protecting investor funds in a SPAC, special purpose acquisition company. Here are some key reasons why the trust account is significant in safeguarding investor capital. Segregation of funds. The trust account ensures a clear separation between the capital raised from investors in the SPAC's IPO and the operational funds of the SPAC. By segregating the funds in a separate account, investor capital is protected from potential mismanagement or misuse by the SPAC's management team. This segregation helps prevent commingling of funds and provides transparency regarding the use of investor funds. Investor protection. The trust account serves as a mechanism to protect investor capital until a suitable acquisition target is identified. It provides a level of assurance to investors that their funds are held independently and are not at immediate risk of being misappropriated or utilized for purposes other than those approved by the SPAC's governing documents. This protection is particularly crucial during the period when the SPAC is searching for a target company. Transparency and accountability. The trust account promotes transparency and accountability. The funds held in the trust account are subject to regulatory oversight and reporting requirements. The SPAC is required to disclose information about the trust account, including its balance, investment strategy, and any significant transactions. This transparency helps investors track the use of their funds and evaluate the SPAC's compliance with the intended purpose of the IPO proceeds. Preserving capital. The funds held in the trust account are typically invested in low-risk, interest-bearing securities. This investment strategy aims to preserve capital and minimize the risk of loss or depreciation of investor funds. By holding the funds in secure and liquid investments, the trust account seeks to provide a stable return and mitigate the risk of investment loss while the SPAC is searching for an acquisition target. Investor exit option. In the event that the SPAC fails to complete an acquisition within the specified timeframe or meets certain conditions outlined in the SPAC's governing documents, the funds held in the trust account are returned to the investors. This exit option offers a degree of protection to investors, ensuring they can recover their capital if the SPAC is unable to identify a suitable target or secure shareholder approval for a transaction. It provides an added layer of investor safeguarding and reduces the risk of permanent loss of invested capital. Overall, the trust account is a crucial component in the investor protection framework of a SPAC. It establishes safeguards and transparency measures that help mitigate risks and provide confidence to investors that their funds are being handled responsibly and in accordance with the SPAC's stated objectives and regulatory requirements.